Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. Marcus had been following Goldman Sachs for years. Every quarter, he pulled up the earnings report. Every quarter, the numbers impressed him. Revenue in the tens of billions. A brand that every serious investor recognized. A firm that had survived every crisis, every cycle, every moment when lesser institutions had collapsed. He felt confident owning it. It was obvious, visible, the kind of stock you could explain at a dinner party without anyone asking a follow-up question. Then, one afternoon in Chicago, he was going through a list of financial stocks when he landed on a name he had never heard. Evercore. He almost skipped it. He did not skip it. Evercore is an independent investment bank, founded in 1995 in New York. It does not take deposits. It does not hold a loan book. It does not run a trading floor. It does not need regulatory capital buffers. It advises. When a board of directors needs advice on a billion-dollar acquisition, and they want that advice to come from a firm with no conflict of interest, no lending relationship with the target, and no proprietary position in the outcome, they call an independent advisory firm. They increasingly call Evercore. Here is what Marcus found when he looked at the numbers. Q1 2026, adjusted revenues of $1.4 billion, up 100% year over year. Not 14% like Goldman Sachs, not 16% like Morgan Stanley, 100%. Earnings per share of $7.53 against analyst estimates of $5.18, a beat of 45% on the bottom line. The largest quarterly capital return in the firm's history. $673 million returned to shareholders in a single quarter. In the advisory fee ranking, third globally among all investment banks on Earth. Not third among independent firms, third among every investment bank on Earth, sitting behind Goldman Sachs and JPMorgan Chase. Marcus sat back and asked himself the question that every investor should ask when they find a number like that. How does a firm with no trading floor, no deposit base, and a market cap of $16 billion end up third in global advisory fees behind institutions worth hundreds of billions? The answer is the business model. Goldman Sachs has a $253 billion loan book. Morgan Stanley runs a $4.8 trillion wealth management empire with a 65% efficiency ratio. JPMorgan carries $2 trillion in risk-weighted assets. Every dollar held against those regulatory requirements is a dollar that cannot compound freely. Evercore holds none of that. It earns advisory fees. It returns the rest. The result is a 5-year average return on equity of 34.6%, in a sector where 25% is considered exceptional. There is a pattern here that goes beyond finance. Stripe did not build a bank. It built the payment infrastructure layer that banks needed and could not build cleanly themselves. Airbnb did not build hotels. It monetized the inventory the hotel industry could not capture. In each case, the specialist started small, was dismissed as a boutique, and then compounded quietly until the league tables told a different story. Evercore started as a boutique in 1995 with a market cap at its IPO of $570 million. It is now third globally in advisory fees. The gap between that market cap and that advisory table position is the thesis in a single sentence. So, why does this business sit where it does? Why is a $16 billion firm competing at the same advisory level as two institutions worth a combined $1 trillion? The answer is independence. When a board hires Goldman Sachs to advise on an acquisition, Goldman Sachs may also have a lending relationship with the company being acquired. It may have an underwriting mandate on the financing. It may hold a proprietary position in the target. All of that creates conflict. Not necessarily bad faith, but structural conflict that the board has to navigate even as they try to make the most important decision in the company's history. Evercore has none of those conflicts. It earns one fee, an advisory fee. When the deal closes, Evercore earns. When the deal does not serve the client's interests, Evercore's only incentive is to say so. That structural cleanliness is increasingly what boards at the highest level of corporate decision-making want, and that demand has been building for a decade while most retail investors were watching Goldman Sachs. Marcus looked at the 5 pillars. Catalyst. The M&A deal drought from 2022 to 2024 suppressed advisory revenues across the industry. 2 years of deferred decisions created a pipeline that does not disappear. It waits. Q1 2026 is that pipeline releasing. Evercore was hiring senior advisors throughout the drought, while competitors were cutting. The relationships built in the down cycle are now executing in the up cycle. Leadership. Number 1 among independent firms globally for M&A advisory in 2026 year-to-date. Number 1 research provider among all firms for 4 consecutive years. Not number 1 among boutiques, number 1 among all firms. Earnings. 100% revenue growth year-over-year. 45% EPS beat. Operating margin of 25.3% in Q1 2026, up from 16.6% in the prior year. 870 basis points of margin expansion in a single quarter. Accumulation. $673 million returned in Q1 alone through buybacks and dividends. Fewer shares outstanding. Institutional ownership growing. The supply dynamic is constructive. Risk and reward. The primary risk is cyclicality. Advisory fees contract when deal volumes fall. Evercore has no recurring revenue base to cushion a downturn. The 2022 drought was a live demonstration. That risk is real and permanent. The current entry timing positions the investor on the right side of a recovering deal cycle with a 2-year backlog releasing. That does not eliminate the risk. It is the honest context around it. The score came back at 85 out of 100. Highest conviction. Marcus had spent years watching Goldman Sachs. He understood the business. He respected the institution. What he had not done was look at the firm that was quietly moving up the same league tables without the balance sheet, without the deposit base, and without the regulatory capital requirement that locks billions in place. The $16 billion firm that just ranked 3rd in the world. The full analysis, including the comparison table against Goldman Sachs, Morgan Stanley, and JPMorgan, is in the Friday Flash for issue 012. The link is in the episode description. Amateurs watch the names everyone talks about. Investors ask, who is winning where nobody is looking? Visit profitbyfriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the Clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.